The Buffett Arc, an architectural blueprint for capital allocation. Today is not Buffett quotes hour. This is a blueprint. Think an investment operating system with load-bearing walls, stress tests, and 2 ways to blow the whole building up. And I'll keep you curious. By the end, you'll have a 60-second filter that kills 95% of ideas fast. And one story where Buffett basically bought $1 for 20 cents. Hold that thought.
System, not aphorisms. Most people treat Buffett like a fortune cookie, but this deck says, no, this is an intellectual system, hierarchical, cybernetic, like a feedback loop, not a vibes-based playlist. Key reframe. Modern portfolio theory says risk equals volatility. Buffett says risk equals permanent loss of capital and the slow erosion of long-term cash generation. That one definition is going to quietly bully every chart you've ever seen. Keep it in mind because it's going to make the Apple slide hit different. In 2 slides, you'll see the fortress layout and why one cracked pillar can collapse the whole thing.
The intellectual fortress. 4 pillars. Here's the fortress. Center, value investing. Around it, 4 interdependent pillars. 1, economic moat. 2, circle of competence. 3, margin of safety. 4, management quality. This is not a checklist, it's architecture. If you remove one pillar, the building doesn't look 25% worse. It can fall down 100%. We'll come back later to the fatal errors, the 2 violations Buffett treats as absolute. Cornerstone time. Price versus value. Price is what you pay. Value is what you get. The entire system spins around one situation, a favorable gap between market price and intrinsic value. No gap, the process stops. Full stop. Intrinsic value here is basically a bond with a variable coupon, discounted cash you can pull out over a business lifetime. And this is the evolution. Graham's bargain hunting meets Fisher Munger's wonderful company at a fair price. That combo is the engine. Now the question becomes, are those future cash flows defendable, or are they about to get competed away?
Pillar 1. The economic moat. A moat is a structural advantage that keeps ROIC above WACC for a long time. Without a moat, capitalism does what it does best, smells high returns, shows up with competition, and turns your margins into confetti. That chart says it all. No moat? ROIC drifts toward WACC over time. Moat? You stay elevated. Next slide. The 4 moat types. Simple enough to explain, tricky enough to fake.
The 4 sources of competitive advantage. 4 moats, 4 quick tells. Intangibles. Brand power that lets you price with a straight face. Coca-Cola. Switching costs. Leaving hurts. Financially, technically, psychologically. Apple. Network effects. Every new user makes the product more valuable. American Express. Cost advantage. You can deliver cheaper structurally, not temporarily. Geico. Also, notice these are not cool features. These are economic weapons. And now, Apple. Not as a gadget company, but as something way more sneaky. Case file, Apple as consumer real estate. Buffett's mental judo move. Apple isn't hardware volatility, it's durable consumer real estate. The moat mechanics, switching costs. The golden cage is the ecosystem, iCloud, iMessage, App Store. You don't just switch phones, you switch identity, habits, and a decade of tiny decisions. And the killer line? Utility versus toy. The iPhone becomes utility-like, high retention and pricing power without the utility regulation part. That's chef's kiss capitalism. But here's the uncomfortable question. Do you actually understand this well enough to bet real money? Next slide gives you permission to say the most profitable word in investing. Pillar 2, Circle of Competence. This pillar is basically epistemic humility with teeth. It's not about how much you know, it's about knowing exactly where you don't. On the slide, yes, inside the circle, too hard, outside. Litmus test, can you forecast business economics 10 to 20 years out with high confidence? If not, outside the circle. And that power of no line, that's how you avoid .com era self-harm. Berkshire didn't win by being smart about everything. It won by not being dumb in public. So we've said no to most opportunities. Now the few remaining, we still need one more shield, price. Pillar 3, Margin of Safety. Margin of safety is the gap between intrinsic value and purchase price, and it's basically your error budget. Buffett flips the question, not how much can I make if I'm right, but how much can I lose if I'm wrong? Then we get the metric most people skip because it's mildly annoying, owner earnings. Net income plus D&A minus maintenance capex, adjusted for working capital changes. Translation, how much real cash can owners actually pull out? And discount rate. Baseline is the 30-year Treasury. No fancy equity risk premium gymnastics. Risk is handled by quality and price. Okay, ready for the satisfying part? The buy a dollar for 20 cents slide is next. Washington Post, 1973, the 80% margin of safety. Here's the dopamine. Market cap, $80 million. Buffett's intrinsic estimate, $400 million, even higher range. Price to value ratio, 0.20x. That's not a good deal. That's the market left the door unlocked and went on holiday. This is what margin of safety looks like when it's not theoretical, it's violent. But even if the business is great and the price is right, management can still ruin it. Enter Pillar 4. Pillar 4, Management as Capital Allocators. CEO's most important job, allocate the cash the business generates, period. The diagram is basically the 5 doors cash can walk through. Reinvest, acquire, dividends, repurchase, pay down debt. And the anti-pattern to fear, the institutional imperative. Copying peers, doing growth M&A because everyone else is doing it, and calling it strategic instead of showing return on capital math. If you hear strategic with no numbers, your wallet should start backing away slowly. So how do you spot the rare jockey who actually compounds value? Next. Hallmarks of a superior jockey. 2 examples. Henry Singleton. Ruthless, rational buybacks when cheap. Treated shares like a weapon. And Tom Murphy. Operational excellence plus bold M&A. Minnow swallowing the whale energy. Then the character test. The newspaper test. Would you be comfortable seeing this decision on the front page read by your family? And Buffett's gold standard. Shareholder letters that admit mistakes. Candor is a competitive advantage because it's so rare, it's basically a moat in leadership form. Now we've got all 4 pillars. Next, how they actually work together, like an algorithm. The Analyst's Toolkit. This slide is your action checklist in 3 columns. Moat analysis, pricing power, churn/renewals, brand as a verb, a Coke, valuation discipline, owner earnings, 15% pre-tax return test, retained earnings creating market value, management scrutiny, letters, buyback behavior, high or low, incentives, and real skin in the game. If you want to sound smart fast in an investment meeting, just ask one question from each column and watch the room get honest. But remember, this isn't a checklist. Next slide is the system-level loop and the 2 ways you can still die. Operational synthesis, the dynamic algorithm. Here's the temple. Circle of competence, moat, management, margin of safety, feeding into each other. A wider moat can justify stronger valuation assumptions. Exceptional management can amplify an existing moat. Everything is connected. And here are the fatal errors, absolute violations. Investing outside your circle of competence, paying up without an adequate margin of safety. No amount of quality compensates for those. None. So what's the final principle? It's not do more work, it's restraint. Final principle: disciplined inaction. The stock market is a no-called strikes game. You don't have to swing. You can wait for your pitch. And that's the close. Let thousands of opportunities pass. Wait for the one that lands inside your circle, protected by a moat, run by a rational allocator, and priced with a meaningful margin of safety. The real edge isn't intelligence, it's patience with standards. Build the fortress, refuse the bad neighborhoods, and only buy when the market's offering bricks at a discount.
And remember, if this mind map has helped you get your head straight, you know what to do. Like it, subscribe, and in the next video, I'll make it even more practical.